Good morning, good afternoon, and good evening to everyone out there. My name is Brett Evans, and I'm the Managing Director for the Europe, Middle East, and Africa region for Atlas Wealth Management. Just while we're just waiting on a few stragglers to come in onto the webinar, can I just get a confirmation that everyone can hear me, please? Just in the questions field, you can just put there. And great, and is my camera working too? Not that I've got a good head for video, but a better head for radio, as I say. But everything's working. Fantastic, guys. Everyone's giving me the thumbs up there. Fantastic. Just on a couple of housekeeping issues, what we're going to do is I'm going to talk for about 40 minutes, and then we're going to roll it over to the all-important Q&A session at the end. So as I'm talking through, feel free to start typing out your questions that you'd like to be addressed at the end. I will obviously go through a slide presentation, which we'll email out to you after the webinar. Also, too, we are going to be recording this as well. So for those who are unable to attend, and also for those who do attend and actually want to go back and revisit some of the conversation that does occur and some of the answers we provide, I will have to preface the conversation to say that obviously we can only provide general advice. So if you are asking specific questions, we won't be able to provide personal advice, but I'll run through at the end how to get in contact with us to seek at that that advice that pertains particularly to you. Just waiting for a few more people to come through now. Believe it or not, this is actually going out to expats in over 35 countries tonight, or tonight my time. I'm in Dubai, but never ceases to amaze me the power of the internet. And obviously, Atlas has been working in this way since pretty much 2011 when we were founded. So we're digitally native, but it never ceases to amaze me the range of countries and cities that we are able to help expats in. Just got a few more people coming through now, and then we'll get the show on the road. First and foremost, just to those out there who are going through financial hardship, it's heartbreaking to see just good, honest, hardworking people going through some incredibly difficult times that, to be honest with you, we haven't seen an economic event like this since World War II. So for those out there who have been furloughed, retrenched, put on unpaid leave, or have to return to Australia, my heartfelt sympathies to you and your family. It's a very difficult time, and it never ceases to amaze me just the strength and the ability to survive adversity that Australians have. And the COVID pandemic is certainly one of those. We're seeing events unfold that no one could imagine, and people having to uproot their homes who've been living in particular countries, for 15, 20 years, but unfortunately their work is linked to their residency visa, and once they lose that work visa, they're having to return to Australia. So, for those out there who are navigating this space, my sympathies and thoughts for you guys there. Rightio, I think we're getting pretty close to getting a good sizable number. Believe it or not, we've actually got about 550 people registered across tonight's session as well as tomorrow's session. Tomorrow, my colleague from the Australian office, James Ridley, will be handling that session. It'll pretty much be covering the same parts, but we wanted to make sure that we ran two sessions that were sympathetic to all the different time zones. Okay, as the saying goes, let's get the show on the road. I'm just going to start showing my screen, and would appreciate it if folks could just let me know once they see the webinar. Fantastic, guys. Okay, so let's get the show on the road. I know everyone's time is important and precious, so let's hopefully provide you guys with some value today. And as I said, we're happy to answer all questions at the end. So no presentation by anyone with a license would be applicable if we didn't have a disclaimer. And obviously what all this illegal jargon means is that anything we're talking about today and tonight will be for general purposes only, and it should not be construed as personal financial advice. As I like to joke, this should be an education session, not as a personal advice session. Okay, so who was Atlas Wealth Management? We've been around the traps for a while now, and we're the leading provider of Australian expat tax financial advice, and we've won a number of awards both in Australia and overseas for the services that we provide. We're classified as a tax financial advisor with the Tax Practitioners Board. We've got clients in over 30 countries, and our specialty is in providing Australian expat tax financial advice, and all of our financial advisors are degree qualified with numerous postgraduate certifications. Atlas Wealth Management is dual certified and licensed. We have a license, an Australian Financial Services license in Australia. And obviously here in Dubai, we're also licensed by the Dubai Financial Services Authority. So who are these, or one good looking guy, one average guy? It's myself and my colleague, James Ridley. James is the Managing Director for the Australian office and looks after our clients in the APAC region. So if you're in Asia through to the United States, James is the man to talk to there, and I look after the Europe, Middle East, and Africa region. James and I are very proud on just the level of advice that we do provide to our clients. James, in his role as the APAC director, he's got unique specialities in navigating the US side. For those who are on the call who are in the United States, you would know the peculiarities of the IRS, who we like to focus the term that they are the original inventors of the flat earth conspiracy theory, because a lot of their rules and regulations don't extend beyond US borders, but their taxation rights do. So I'll run through at the end if you have any questions and you want to speak to James, how to get a hold of us there. So what we're going to talk about today is a bit of an update on the economy, an update on the tax from the ATO's point of view, update on super, property, investing, and then everyone's favourite, the Q&A session at the end. I promise not to be too drastic or downbeat in my conversations with respect to what's going on in the world at the moment, but we just want to provide a pretty much a unemotional binary take on what's going on with respect to A, the economy, and B, how the COVID is affecting all these different areas of finance that do affect Australian expats. Okay, so first cab off the rank we're going to talk about is the economy. And just recently we saw some data coming out, which we call the flash PMI data. So this is essentially a measure on the economic activity of the private sector. And according to the latest data, the business activity contracting following 2 months of solid growth has occurred, and that's primarily been due to obviously Victoria going back into a lockdown. The survey also indicated a sharp rise in spare capacity as sales and production requirements dropped, which has further dampened the job market further. We'll run in through the information on the unemployment data shortly. Prices, meanwhile, indicate rising inflationary pressures, and this is not because the cost of the goods or services is going up, but the actual delivery. We are having supply chain disruptions. If you can imagine, with the number of flights diminishing, it means cargo's down. Obviously, we are seeing border closures, and it's becoming more and more difficult to move goods around. So that is increasing the cost of that supply, and we are starting to see a bit of inflationary pressures on the cost of goods sold. You'll see through this presentation, quite often I like to show graphs because I find it's an easier way to explain a concept. And this graph to me typifies pretty much how the private sector in Australia is going. So as you can see, they're going through April, May, June, March, April, May. We did see a massive contraction, obviously, in the PMI. And then we saw a bit of a rally as the lockdown restrictions were lifted. However, as we can see here with this latest one, we are seeing a contraction back. And the big question we're sort of dealing with right now is, for how much longer is the Victorian lockdown going to continue? We saw this week the Victorian Premier wants to put into place into legislation into the Victorian Parliament that he has the power to continue this for possibly another 12 months. So that's quite a scary thought. Not that I think they will need to go for another 12 months, but given the fact that the Victorian economy is 1/4 of Australia's GDP, it is a massive consideration that we need to take into account. There's also some articles recently about the number of well-heeled Victorians who have been fleeing both Melbourne and Victoria itself. It does, from our point of view, give us an idea that people are preparing for a longer lockdown period, or at least stage 3 restrictions for the short and medium term. So here we see pretty much the GDP growth, and surprise, surprise, we are seeing a contraction in GDP growth. As I said, just if you look at Victoria alone, they contribute 1/4 of Australia's GDP. And obviously with stage 4 lockdowns in place, we are going to expect to see this continue. The big question is for how long? And that's the unanswered question that we have. We're obviously all banking on having a vaccine coming out sooner than later, but for every week that goes by, these economic sanctions, I guess you could call it, are costing the Australian government $1 billion a week. So the longer this goes on, the more it drags on. And what we're starting to see is, if you look here, this is the federal government budget balance, and as a percentage of nominal GDP. And as you can see, we are certainly in uncharted territories, even going back into the early 80s, back into 81. If you look at those numbers there, and most will look for 87 and those types of events, and also 2009, 2010 with the GFC, we certainly weren't in anywhere near this scenario in the past. And that's why we talk about, this is a economic event to be reckoned with. But at the same token, it's not the same for everyone. And we'll talk about the dangers of averages throughout the course of this presentation. So there's been 3 main contributors to GDP, and this is what we start to see things fall off a bit. So the first one is obviously the mining investment area. BHP and Rio are doing very, very well. They've been solidified by the fact that China has recovered and China's growth is improving. And I'll show some data in a sec to just show you where we're getting these numbers. For those who are interested in a bit of the data nerds like ourselves, this information that we're releasing through this presentation is released every month through the Australian Bureau of Stats as part of the ABS chart pack, which can be found on the RBA's website. We like this data because it's unemotional. You can certainly draw information and data from different sources, but with this data, it is just unemotional binary ones and zeros as it's been reported to the Australian federal authorities, and obviously converted into these pretty charts. So we can see their mining has contributed to GDP, but as you can see, their government has been probably one of the largest contributors, and that's obviously coming through by virtue of the stimulus package that had been released by the government. These numbers are up until March. There is a bit of a delay in when this data comes through, and what we often talk about is we are seeing a precursor as to what we can expect going forward. Imports, surprise, surprise, have been a very large component. And that, I think, is primarily driven by, obviously, going into lockdown. We are seeing people buying more and more electronics, work from home setups. I've seen some pretty flash setups that clients have been showing me. And, when you look at the numbers that have been announced by both Harvey Norman, JB Hi-Fi, you can see where people's dollars are being spent right now. So the biggest battle that both the Australian government and also 2 foreign governments have as well is, as much economic stimulus as they release into the market, it may be hitting Wall Street or the financial markets, but is it getting through to what we call Main Street? And that's mums and dads. Up the top there, we've got the household income and consumption. So I'm not going to talk in colours here because I'm colourblind. So those who are out there who are colourblind as well, you'll sympathise with me. So I'm just going to talk about, in general phrases, consumption, obviously, versus disposable income. As you can see, we have seen a dramatic drop in consumption, and obviously disposable income is picking up. That is also in combination with our savings ratio picking up. As you can see there, people are saving on average just greater than 5% of their income, which doesn't sound like a lot, but given the fact that if we go back to pre-GFC levels when we weren't saving anything, it's certainly a lot better. And we will probably see if that lifts as up high as 10%. The biggest problem that Australians have at the moment is the exceptionally high cost of living combined with the high amount of debt that Australians are carrying. If we look at the US numbers, CNBC released a report about a month and a half ago that actually said on average, Americans are saving 33% of their disposable income. So in America, the cost of living is a lot lower. The cost of buying a property in some areas is a lot cheaper than Australia, and they're able to sock a lot more money away. So the biggest battle that the governments have right now is how to engage the consumers and get them spending. To me, the first way they're going to do that is obviously bring a vaccine, but B, they need to show that they have this under control. The longer that this goes on, the more doubt that will creep into everyone's minds, and then obviously that'll exacerbate the nervousness of Mr. and Mrs. Joe Consumer. Okay, on to the next one here, and if I try that again, there we go. Okay, so with respect to Australia, obviously we're actually an export-driven nation. Believe it or not, when you look at economic classifications, believe it or not, we're actually considered a third world country due to our reliance on exports and raw materials and commodities and rural aspects. So believe it or not, we're actually a third world country, but we won't hear anybody say that. Here we have broken down the different trading partners that Australia has. And as you can see there, China is still by and large our largest trading partner by export. We are reliant on China from both our commodities, iron ore, LNG, all those commodities, but also from a rural aspect in terms of exports, beef. And then we've also got considerations like we've seen with the trade wars that have been going on recently with respect to Australian wine imports into China, and also barley sugar and quite a number of things. So we do have a lot of sectors that are reliant on China. And if China does go through a bit of a whoops, then we could see the economic conditions in Australia be exacerbated by virtue of decreased demand. At the moment, China is still demanding our goods. We are going to see a bit of saber rattling with respect to trade sanctions. Obviously, Australia's been vocal with respect to the way that China's handled the coronavirus, combined with us sort of being dragged in by virtue of association with the US-China trade wars. So we're just watching that one closely. As long as we can continue our core exports to China, then that will certainly, I won't say bolster the Australian economy, but certainly put a crutch under the problems we're experiencing right now. So how's China going? Well, you can obviously take on board Beijing's rhetoric, but we prefer hard data that comes out of their production, because it's very difficult for them to change these figures. So as we can see there, surprise, surprise, they had their very large dips, but China went into a very aggressive lockdown to try and get ahead of dealing with the COVID-19 pandemic. We saw massive dips across electricity generation, plate glass, cement, crude steel, and steel products. But the positive thing we can take out of this is all of those areas have bounced back. We look at these data points as a litmus test as to what's happening in China, because in turn, obviously, if steel products and crude steel is being produced, therefore they will have a raw demand for Australian iron ore. If electricity generation is on the backup, they're going to have demand for obviously Australia's coal supplies in order to feed those power stations. So when we look at all these numbers, in isolation, it may not seem like a big deal, but across from an Australian point of view, it is an incredibly important part of just helping us get through these very difficult times. So touching on the point of unemployment, and there's going to be a lot of confusion out there, because believe it or not, there's actually two levels of classification with unemployment. You have what's called the official rate, which the official rate, those people who've gone to Centrelink, registered for the job, I always get these two confused. There's job keeper and job seeker. Job seeker classification, and obviously to collect their entitlements that way. Then there's the unofficial unemployment rate, which that also includes those who haven't officially registered for unemployment benefits, and also to those who are on the job keeper package but are currently doing 0 hours of work. So obviously the job keeper package there is there to encourage employers to keep their staff on their payroll. And by doing that, it doesn't necessarily mean they have to work, but they're still on their payroll itself. When you look at the numbers from the unofficial unemployment rate, we actually hit 15% back in April. That number is coming down gradually, and it's down to about 11% or 10.7% at the moment. However, we are starting to see that pick up again, obviously with the Victorian state going back into lockdown. The other concerning point too is obviously the official jobless rate, which is those who are unemployed and have registered benefits, is on the increase. And I'll run through in the next slide some of the modelling that the federal government has done, and give you an idea of what they're seeing as this plays out. Obviously, when it comes to the RBA, they're going through and looking at this as a very conservative aspect, so they do take into account a lot of things, but generally speaking, they are expecting it to increase over the rest of the year. An unusually large fraction of people did not actively look for work in April and May because there were in many cases simply no suitable jobs to apply. They were recorded as having left the workforce and not as unemployed. And that's where we get these different types of data sets. Job opportunities become more evident. The RBA expects that many of these people will start to actively look for jobs again. This increase in labour force is expected to outpace any recovery in employment, and that's why they are expecting the rates to go up over the next couple of years. And the next chart here might be quite sobering for a lot of people, but as we can see here, this is the official unemployment rate. This is not the unofficial employment rate, so just keep that in mind. So this is for people who have registered for Centrelink benefits. So as you can see there, as a worst case scenario, they are expecting the official unemployment rate to go above 10% through the later part of this year. Even at a median level, it's just short of 10%, 9.8%. And even on a conservative basis, they're still expecting almost the same amount. So pretty much, unfortunately, 1 in 10 Australians who are able to work is more than likely to be registered for unemployment benefits by the end of this year. Now, obviously, when it comes to the recovery phase, that's the big question. And obviously, in a best case scenario, they are hoping that the official unemployment rate will be down as low as 6% by the end of 2022. So that's still, 1.5 years away. So it's quite a long while away. And 2.5 years away. And when we look at those scenarios, it is pretty conservative when we look at those numbers. As a worst case scenario, it could be up as high as 9% by the end of 2022. So it's going to be a matter of how quickly the Australian government can fire up the economic engine of the Australian economy. And obviously, if you remember back to that chart before I was showing you with the flash PMI numbers, getting that private sector going. At the moment, we are seeing a lot of the corporates not at a high capacity or utilisation rates. The CapEx spend is low. Everyone is socking cash away. And it's going to be a matter of the government really coming out with incentives to employ and encourage both private sector companies, corporates, and the like to get out there and start spending money, actively hiring, and getting the cash flowing through the tills again. Okay, so the next one we've got here is tax, which is never anyone's fun topics to talk about. So what we're going to talk about here is probably the most, I guess, not debated, but asked questions that we find with respect to tax and the COVID-19 pandemic and the implications there. And pretty much the bulk of that are those Australians who are stuck back in Australia because they were repatriated out of their country, either by their employer or that they didn't feel that they were in a safe place and they've returned to Australia for the short or medium term. Up until through March and April, the ATO was very pragmatic and on the front foot, and they've actually said that Australians who are normally resident overseas, who have come back to Australia temporarily, will not be considered as tax residents as long as that tenure in Australia is for the short term. Just recently, obviously about a week and a half ago, the ATO recently updated its guidance on employees who have been found themselves obviously still here. And we do know of a number of scenarios where borders are still closed for a lot of clients, or from a health or safety point of view, there has not been any improvement in those environments, so they're still resident in Australia. What they've virtually said to employers is that they do not need to register for PAYG withholding where the employees are temporarily working in Australia, as long as they leave by 30 June. However, the next step we've found is now that they're telling foreign employers as well as Australian employers that you've had sufficient time to deal with this and obviously work through the problem, and they've updated guidance to be clear that from the 1st of July 2020, where employees continue to work in Australia and the employment income is assessable, that is Australian assessable income, then the usual employer obligations will apply. So what does this mean for you as the employee? It just means that if you are in Australia and you're normally resident overseas and you start doing work for an Australian subsidiary or an Australian parent company that is locally based, then there may be implications when it comes to how your employer treats your tax when it comes to your salary. So there still is relief for an employer who continues to be a non-resident in Australia for tax purposes, and the work that they're performing is truly foreign sourced, but this is dependent on everyone's individual facts and circumstances at the time. So when we go through and look at obviously the 4 tests that Australians either qualify or disqualify as an Australian resident, there are the 4 tests, which is the resides test, the domicile test, the 183-day test, and then the Commonwealth Super test. The Commonwealth Super test is pretty much not relevant for anyone unless you are working as a diplomat or you're employed by the Australian federal government overseas, which could include military as well too. So the length of time in Australia is becoming increasingly important, because now if you were back in Australia, say in February, then now you've pretty much gone through, or you're about to go through, depending on what time, your 183-day rule, which is in Australia. The 183-day rule is not a sole determinant of itself, but it is one of the components that you need to be conscious of if you are going to be in Australia for greater than 183 days. So the ATO needs to be satisfied that the person's usual place aboard remains aboard, and that they do not intend to reside in Australia. So from a personal perspective, documenting why you're doing what you're doing at the moment is very important, so that if you do get a tap on the shoulder, you can show why you've gone longer than 183 days, but also to why your normal residence is still overseas. So therefore, you still pass the resides and the domicile test, and you're only failing the 183-day test. It's very important from a, it's not the most exciting thing to do, file notes and those sort of things, but that could also entail sending emails or your emails between you and your employer, or family members as well too. I think the hardest thing people are coping with right now is it's a difficult enough time as it is to be managing your personal life, let alone worrying about all these extra influences like tax residency and all these sort of considerations which could come back to bite you. So it is important. You can make it easier for yourself by just obviously communicating a lot through emails, because those emails, you can save them and you can present them at a later point in time to show that why you should still be considered as a non-resident. Double taxation agreements play a very big part from an expat's point of view, and it's you need to be very wary of if you are going to be breaching the 183-day rule. And the reason being is employment income derived by a person who is resident of another country from performing employment duties for a short period will not be taxed in Australia. However, you need to really ensure that you are not your employment income is not taxed in Australia based on these qualifying conditions. So obviously you're a resident of another country which has a DTA, you're not present in Australia for more than 183 days, your salary and wages are paid to you or on behalf of an employer that is not resident of Australia, and your salary and wages are not deductible against profits of an Australian permanent establishment of your employer. So you need to really make sure that if you are normally resident in a country that has a DTA with Australia, that your extended time frame, if you are going to be in Australia for greater than 183 days, is not going to be jeopardized by your time in Australia. So for those who are in Australia for that period, you really do need to seek advice with respect to what the implications for you may be. The ATO has provided this example of Ian. I don't know where they get these names, but we'll go through this anyway. So Ian spent the following time in Australia. He was in Australia from the 15th of December to the 3rd of January. So obviously came back to Australia for Christmas. Obviously returned to his country of residence, of which has a DTA with Australia. Then obviously because of COVID, he returned to Australia on the 10th of March 2020, and he remained here until the 1st of October 2020. So essentially he's been here for 196 days. As Ian's time in Australia exceeds 183 days, the DTA does not apply to prevent Australia from taxing Ian's salary or wages from an Australian source in the 2019-20 and 2020-21 income years. Obviously, this applies to people who work for companies that have a presence in both Australia and obviously overseas. So if that does apply to you, then tread carefully and just be careful. So the next topic we want to talk about is superannuation, and this primarily applies to those Australian expats who actually reside in a country where you earn a provident fund or mandatory benefit fund, like Hong Kong, Singapore, United Arab Emirates. There's quite a few of them there that do pick up. So, primarily we're working with people who are working for Emirates Airlines, Cathay Pacific, those who have these mandatory provident funds or airline provident funds. This is a key consideration because unfortunately, for the first time in the aviation sector's experience, in times gone by when an airline or a country experienced problems, then you would just move to another airline, another country. At the moment, there is no other country or no other airline to move to. So what we're seeing is a lot of Emirates and Cathay Pacific crew are being let go, unfortunately. And what's actually happening is they are crystallizing their provident funds. Now, most people say, so what's the problem with that? Unfortunately, from the ATO's point of view, they are viewing this in quite a punitive way, and they're using Section 99B, which means that if you crystallize the gains in your provident fund in the same financial year that you return to Australia, that the withdrawal will be treated as taxable capital distribution from a foreign trust and taxed at your marginal tax rate. And the reason being is the ATO views these provident funds not as a foreign super. And the reason being is they're there not to provide funds for retirement. You can use that for funds for retirement, but you can also use that money to buy a boat or many other things as well too. And because of that reason, they're not viewing these as a foreign pension, they're viewing these as a foreign trust. So be careful if you are in that situation right now where you have been let go and you do have a provident fund or some sort of variation of end of service benefit. Just be careful that you seek advice as to how you can manage this risk, because a lot of people, unfortunately, their residency is tied in with their work visa. And as they're being asked to leave by the respective airlines, what's happening is they're returning to Australia and their provident funds are crystallising capital gains in the same tax year as them returning to Australia. And there may be some punitive events coming around the corner for them, unfortunately. So next one we've got to run through here is property. I'll just take a quick sip of water here. Now, the property market is probably our most concerning market, and the reason being is that we're not seeing a completely transparent view of the Australian property market. And the reason being is you've obviously got the banks offering a 6-month repayment holiday combined with the rental eviction moratorium. And what we're seeing at the moment is even if you have a tenant in your property, you can't evict them if they can't pay. Now, that's okay while the bank is offering you a repayment holiday. However, we're all coming to a peak next month. Now, we have seen the Victorian government extend their eviction moratorium through to the end of the year, and we have heard of banks who are working on a case-by-case basis with their clients as to extending their repayment holidays. However, you can only kick the can down the road for so long, and we are going to start to see quite a lot of pain coming around the corner. NAB about 2 months ago came out and said on their modelling as a worst case scenario, they're looking at a 32.7% fall in Australian property over the next 3 years. That is worst case scenario, and obviously that was 2 months ago. What it may be and what their forecast may be in the next couple of months as we have more data coming to hand, maybe worse, maybe better, we're not sure yet, but they're the ones who are sitting at the coalface when it comes to knowing how people manage their money. The Australian banks are incredibly adept at being able to almost forecast consumer behaviour because of their AI technology and using internet banking. They can see how many people are paying their bills on time, they can see how many people are not paying their bills on time, and they are able to anticipate a lot of this information coming through. Clearance rates for us at the moment, we take them with a grain of salt because it's like everything, you can make the numbers look as good as you want as long as the data set isn't representative of the whole. Here I put up an example of the ACT clearance rate last week. They were crowing about it being at 87.8%. However, this is based on just 41 of 64 scheduled auctions. ACT is not exactly a small state or territory, I should say. And to me, 41 sales of property does not give a true indication of how that sector is going. As I mentioned before, we are anticipating the fiscal cliff occurring later this year, early next year, as the JobKeeper rent relief for tenants and bank mortgage holidays wind up. Obviously, the banks can't continue to carry people for too much longer, And we have already started to see banks reaching out to their clients. They're actually calling up people individually to gauge what their capacity is to start making those repayments. So for those who've been following us for a number of years, you recognise this chart, and it's always been a chart of great concern for us. And what this is a housing prices and household debt ratio to household disposable income. So the chart on the left there, that's household housing prices. And at the moment, during the peak, just before things started to pull back, household prices were 5 times that of the average Australian's disposable income. And on the right there, we've got debt at just short of about 1.82 times the disposable income. Our concerns stem from the fact that we are seeing a pullback in housing prices, and I'll run through some of the numbers in a sec, but we're not going to see a pullback in housing debt. And this is going to be the main concern. Australians have struggled to make repayments on their loans for the better part of the last 2 years. And that's because we saw wage indexation wasn't working. We saw wages actually pulling back rather than increasing in line with obviously the rising cost of living and also the cost of taking on more debt. So now we have a scenario where Australian incomes are dropping dramatically, but what's happening with their debt and how are they going to service that? I think in a news release from the NAB this week, this month, floored me, because this is the first time I've ever seen a bank CEO say this. And essentially what Ross McEwen said was, to paraphrase it, there's going to be unfortunately some situation where it's better off for people to actually sell up and start again so that they can take some equity out of the situation. I've never in my 24 odd years of being in the markets ever seen a bank CEO recommend people sell their property. So we are going to get to that point, not just yet because people are being held up and supported by the banks, and also by JobKeeper, and also to eviction moratoriums, but at some point they're going to have to pay the piper. To back that up, here's another article, and this came out this week, and this is talking about CBA actually having a conversation with their customers recommending that they sell. So if we do start to see the rental eviction moratorium lifted and people aren't getting rental payments, you are going to start to see an increase in the number of properties hitting the market. It's not going to be straight away at the same time. People are going to hang on for as long as they can. But if we look at the numbers that I'll show in a sec, we are starting to see a lot of pain coming through. And at some point, the banks are going to lose patience, and they got to start to either force people to sell, or they'll do mortgagee in possession and start to push that themselves. This is another chart that's provided by the ABS, and to us, this is a pretty clear idea as to what's going on. And I should say, these numbers are as of March. So these came out in August. There's obviously a delay between when the information is posted from the banks to APRA, the Australian Prudential Regulatory Authority, and then obviously released out of the market. So the main one I want everyone to look at is the one on the right-hand side, which is this is banks' non-performing assets, which otherwise known as people not paying their loans. So that's that pie there by businesses. That was the GFC. Now, the reason, if you look there, business loans haven't spiked. And the reason being is Australian companies are running their balance sheets a lot leaner with less gearing than they were pre-GFC. So that's why we're not seeing that spike. But the big one of concern, if you ignore the personal, is the housing at 42%. Now, if you look there at the peak during the GFC, housing defaults were about 0.8%. These numbers up until March, so we're not even taking into account April, May, June, or July, we're already at 1%, which is greater than what we were going through from a default level back in the GFC. So there was always pain in the property sector pre-COVID-19. This problem, you got to see this number sort of almost trade sideways as, we're not seeing any banks foreclosing, but we are going to see this number start to pick up and rise going through once those bank repayment holidays and also to the rental evictions do cease. One of our main concerns about the property market is vacancy rates are on the increase. So obviously Airbnb has been a great boon for a lot of property owners, and there's a lot of property owners who went into the short-term market. Now we've seen obviously not a decline, a fall off the cliff of international visitors and travellers. They've all deviated from short-term rental accommodation across to long-term. What's that done is it's increased the rental stock, and as a result, vacancy rates have increased significantly in Sydney and Melbourne. Obviously, with the lockdown occurring in Melbourne and Victoria in general, these rates are going to go up even further as people aren't going to move. They are going to, obviously rely upon that moratorium on evictions, and people are going to stay put. So what we're also seeing too is obviously a lot of tenants have obtained discounts from their existing rental agreements, and advertised rents have also fallen of late as well too. These numbers, a property agent may not be, touting these numbers, but once again, these are, unemotional and unconflicted data that's coming out of both the RBA, CoreLogic, and REI New NSW, and REIV, which is the Real Estate Institute of New South Wales and Victoria as well. As you can see there, going through, vacancy rates in both the capitals have spiked, and obviously the rent growth has dropped as well too. So put yourself in the scenario of, what I consider a lot of Australians who have been, I guess, not sucked along the property journey, but encouraged to over leverage themselves. There's a lot of people out there who are probably on combined incomes of 100,000 Australian dollars a year, and in normal times should have just probably had their own property and plus one other investment property. Unfortunately, so many people, as the property market rose, they drew down their equity to buy another property, and they've ended up with 2, 3, sometimes 5 properties. Now, they couldn't afford those properties as it was. Now you've got the scenario of some or all of those properties may not be getting any rent. They themselves may have lost their job. We're going to start to see quite a lot of pain start to come out, and we haven't seen this play out just yet. And the numbers coming out from a loan deferral basis are quite staggering. So if we look at all deferred loans in Australia at the moment, we're looking at $274 billion worth of loans that are on deferment. That's about 10% of all loans. If we look at the housing sector, $195 billion of housing loans are on deferment. That's 11% of all housing loans out there. Small businesses, obviously $55 billion. We are starting to see some of those trade out, but a lot of them aren't, and that is a concern for the banks as well too. And the banks have been very vocal about talking about they're engaging with their small business borrowers, and trying to work out a way to navigate that space. But as you can see there, we're not talking about small percentages here. We are talking about these percentages across Australia. So when it comes to how those loans look, we can see here from on the chart on the left there, obviously April was the spike in the year of when people elected put their loans in deferral, and we saw obviously May and June that continue. Unfortunately, July, we didn't see enough, even though we saw a bit of an uptick in that PMI number from the private sector, and we did see a number of loans exit from deferral. There still was a net increase in loan deferrals. If we go to the chart on the right there, we're looking at the risk profiles for housing loans. So of the deferred housing loans, I think it's about 9.2% have a loan to value ratio of greater than 90%. Now, what that means is when you look at their loan as a percentage of the value of the property, the loan is almost as much as the property itself. And that is before taking into account any further falls in property. We are going to start to see a lot of people going into what we call negative equity, where the value of the property is less than the value of the loan. And that is a major concern. Almost 15% of deferred loans are interest only, so they're actually not even paying any of the principal off. And as you can see there, almost 35% of those loans are investor loans. So if we look at on the far right hand side there, the total housing loans, out of all the loans out there, almost 5% have a LVR greater than 90%. About 17.2% of loans are interest only, and of the total housing loans, approximately about 36% are investor loans. So as you can see here, it is a very sobering number to look at when you look at the whole scale of what we're starting to see eating into what is pretty much an Australian institution of property. For the Australian property market to be a healthy market, we rely upon 4 main categories of buyers: first home buyers, owner-occupiers, investors, and migrants. First home buyers, unfortunately, probably the worst demographic affected by the COVID-19 pandemic has been first home buyers. Young people, Gen Y, I think, is the general classification for them, but those between the ages of, say, 20 and 35. What we've seen out of this scenario is the ability for them, because they've either taken a wage hit or are earning no wages at all, it may defer their purchase of their first home by between 2 and 3 years. So for those who were anticipating coming into the market over the next 12 months, that has now been pushed back another 2 to 3 years, because obviously their ability to save has either decreased or totally evaporated due to either a reduction in salary or losing a job. Owner-occupiers are still there, and we are still, seeing small movements in that space. But at the moment, we're not seeing a what we see a rotation between a lot of things. We are going to probably start to see, as we said before, banks are reaching out to their customers to talk about them downsizing. So if people can't make their repayments on a 4 to 5 bedroom house, they may be encouraged to go down to a 2 to 3 bedroom house. So we are going to start to see a bit of movement in that owner-occupier space. Investors, as you'll see in the next chart, have virtually checked out. They haven't been in the market in earnest like they have been in the early part of 2010 to 2020, since about 2018, believe it or not. And the market's been solely reliant on migrants and owner-occupiers and first home buyers to prop that up. Now, obviously, with investors, that's going to be on the nose, and we're not going to see them return for a number of years. And last of all, migrants. The Australian property sector has relied upon migrants to do a lot of the heavy lifting when it comes to soaking up excess supply. Obviously, with the borders closed, and also too, the numbers capped on the number of migrants coming through, this is a major concern for the property sector, because who is going to buy all this excess property? The other condition that the Australian government set as well too for migrants is that they're going to stipulate that 60% will have to move to a regional location, whereas up until recently, obviously most migrants have been gravitating and captivated by the major metropolitan areas. They're going to be encouraged to go to regional centres for a period of 3 years, or depending on what classification you come through. So you're not going to see these capital cities have this influx of migrants soaking up this demand. So it's going to be interesting to see how this plays out, because this cap doesn't, it is there at the moment from what we can understand for another 2 to 3 years. And then obviously they're going to change that, and the government is going to provide further updates. But at the moment, that's the information we have at hand. So here we see housing credit growth for both owner-occupiers on the left and investors on the right. And as you can see, we've seen housing credit growth in the owner-occupied market, even up until 2020, has been around 6%. With respect to investors, for the better part of 2019, halfway through that, there's been zero growth in investors, and in actual fact, we're seeing negative numbers now. So we are going to start to see a massive retraction in the number of investor loans going through, because also too, you need to consider the fact that the banks have put blocks on borrowings or providing mortgages to certain postcodes, and also now to people who work in particular sectors. If you work in a sector that's hardest hit, you're going to find it very difficult to obtain a home loan, even if you are solvent. So we always like to sort of, provide a bit of a comparison. And even though the US has been trumpeting how resilient their property market has been, as you can see here in the June, we saw a massive spike. The delinquency rate has gone through the roof. We haven't seen foreclosures pick up yet, because the US banks have taken the same approach as the Australian banks in sort of working in a conciliatory way in trying to manage this scenario. The biggest problem in the US is what we call their no recourse loans. So virtually you can borrow as soon as your loan is greater than the house value, you can hand the keys back to the bank and they can't chase you for the money. Obviously you'll have a rubbish credit score, but there is no recourse against that, as opposed to Australia, where the banks will follow you to the four corners of the earth to get their money back. So I think the banks learned a lot from those foreclosure experiences back in the GFC, which is where that spike recently was, and they're going to try and avoid that scenario, because obviously what happened was you had vast swathes of suburbs who just had empty houses, and those houses were left to ruin. Okay, so running on now to the next section, which is the investor section. And the difference between investing in, say, shares, managed funds, ETFs versus property is the equity markets have the ability to price risk and price an event immediately and within seconds. These days, the market reacts in microseconds when it comes to economic events. And as soon as this did start to come out, it was pricing in the worst possible scenario. So what we like to talk about is the law of averages is always very difficult to apply to the equity markets, and we'll go through and demystify a few things there. But look, I think this quote by Sir John Templeton is, probably one of the best quotes I love. That bull markets are born on pessimism, grow on skepticism, mature on optimism, and die of euphoria. What that virtually means is the start of the next phase is always at the worst possible time. That great saying, it's always the darkest before the dawn, is probably the best analogy they can provide to explain this quote. So what we're going to run through is essentially what we're looking at the equity markets at the moment, and what's on the horizon, and where we see concerns and an opportunity. So going through here, reporting season is almost finished. Nearly 70% of the market has reported their 30 June results. 67% of companies reported falling earnings, and 53% cut their dividends. 10% of companies have suspended their dividends. To us, that's actually not a bad result going through what we're going through right now. And I think we can thank the GFC of purging companies with high debt for that scenario. Companies in the past that were running gearing levels of 60 to 70% were now running 30 to 40% coming into the COVID pandemic. And to me, that has been the saving grace for them, because if they were running a similar balance sheet as pre-GFC, then we'd see a massive level of attrition through the market. But we haven't seen that, thank goodness. So those who are on both our March and April COVID webinars, remember I was showing up a chart, and to me, the ASX 200 is probably a chart that people understand the most, because we're obviously talking about companies like Qantas and Telstra, Wesfarmers, Coles, Woolworths, ANZ, BHP, and so forth. So what we have on the left here is at the peak back in March, obviously the market fell at a rate of knots. And this was precipitated mainly because there was A, shortage of US dollars, and B, the risk of not knowing where this was going to go. Then we saw, obviously, oops, sorry about that, hit the wrong button there. Let me just go back a bit. There we go. Then we saw what we call a relief rally. And a relief rally is pretty much people rushing in and picking up holdings and virtually trying to go in and buy the dips. In a normal scenario, that is what we call a pragmatic solution. From a technical analysis point of view, you can see it here. We actually had what's called an inverted flag pattern, where we see the lows get higher, but the highs stay the same, and we get this compression of the market. And as we see here with the breakout, that is normally a buy signal, and that's one of the reasons why it gapped up. However, since pretty much the better part of June through till today, the market has been range bound. Now, even with all the economic news and all these scenarios being played out, and I'll address the US issue in a sec, because that's a very simple situation because of obviously the tech sector. But when we look at the Australian sector right now, on average, if we look at the 200, it has been holding up okay. Obviously, going through from June through till say May through till June, July, the market has been relying on company releases, as well as sentiment, as well as obviously stimulus packages announced by the federal government. Now we're going through what we call the coalface reporting, and that's companies reporting their 30 June results. And as we can see here, the market hasn't exactly embraced it, but it hasn't been concerned at the same token. But to us, there are some key issues that we'll run through in the next couple of slides. So as we can see here, the Australian profit results, they weren't too bad. So we see 28% were better than market expectations, 27% below, and the remainder were as expected. So it wasn't the four horsemen with the apocalypse coming around the corner, which is a great scenario. And we didn't want to see that, because obviously we see an erosion of confidence by the investors, and then we start to see that same scenario pan out like we saw back in March, when you see an absence of buyers and a wave of sellers coming through. Australian investors are incredibly or intrinsically linked to dividends. We have a high dividend culture with Australian companies. The average yield in a normal time for the ASX 200 is about 4.2%. When you compare that to the S&P 500 at 1.7%, you can see that Australian investors do hang their hat on dividends, and especially retirees, they rely upon all of those dividends to come through. So as we can see here, 28% of companies actually increased their dividends compared to 12 months ago, 55% downgraded, and the remaining were flat. Obviously, the companies that were downgraded primarily companies that have been affected the most. We're looking at the Qantases, the Flight Centres, the Crown Resorts, the travel, tourism, leisure, all of those sectors have been the hardest hit. On the other side, we have companies that have actually increased their dividends from 12 months ago. Coles, Woolworths, the health sector, IT. These are all areas that are actually doing okay or actually going very well in this scenario. So you always need to be careful when you look at averages in the market, because averages, it's like that great saying that I've said 1,000 times, and people are probably sick of me saying it. If you put your head in the microwave and your feet in the freezer, on average, you're a good temperature. But at those extremes, they're not in a very good scenario, or they're in a great scenario. If you look at obviously the likes of the health stocks right now, CSL, they're locking in vaccines. Obviously Sonic Healthcare, Pathology, IT companies. Afterpay is a good example of something that's been performing very well. And then on the other side, you've got companies like Qantas. Today announced that they're letting go 2,500 ground personnel to outsource their ground baggage handling as well too. So, we can always find either side extreme experiences going on out there, but to us, it's very easy in a well-diversified portfolio to focus on the positive. And sometimes people want to take a bet, and Australians have that nature of wanting to bet on two cockroaches running up a wall. There are those who are talking about buying Qantas and buying Flight Centre and buying Webjet, all these sort of contrarian plays. And look, that is a consideration. We're not going to go into too much detail today on that strategy, because to us, we feel it's too soon. But generally speaking, you want your sometimes some stocks are cheap for a reason. Just remember that. Don't just buy things because they're cheap, because they might be cheap for a very good reason. So in terms of what is ahead for the third and fourth quarter of 2020, historically, if you go back to 1985, the September is actually the worst month of the year. So we're expecting this scenario to probably play out for obviously, even if pari passu, as the lawyers like to say, nothing really changes with respect to COVID or the economic scenario. Generally speaking, we always see a sell-off in October, and that's primarily driven by a lot of companies going ex-entitlement with dividends. If we see that combined with worsening economic data or a delay in the vaccine coming out, then that actually may exacerbate a sell-off in September. And to us, we were viewing that as an opportunity in those core areas that we do see resilience in this current area, obviously like health, IT, consumer staple, those sort of type of sectors. The big question we've got is obviously the US election is coming up the later part of this year, and how the markets are going to treat that. Obviously, Joe Biden, is causing consternation for Trump. It really is, to us at the moment, almost impossible to predict how this is going to play out, because it is changing on a daily basis. And obviously, US trade sanctions and US trade wars between China is going to really flare up as well too. China's going to do everything they can to sort of rattle the saber to try and cause as many problems as possible with respect to the US elections. So we see that as another concern going into October, November as well too. December, the reason for that is a strong month is we see the famed Christmas rally, and that's because usually between $16 and $18 billion worth of Australian dividends are paid out by the three major banks in the space of a week. So I won't talk too much about that, because that can skew the numbers quite a lot. But essentially, from what we're seeing, from September through to October, November, is certainly a pullback in the market in September by virtue of companies going exit dividend. Also, too, the market is driven on what we call a news vacuum. And quite a lot of times when we go into that September period, the news vacuum occurs, and people do get nervous when they're not getting that handheld or that constant feedback of data information, either company-based or economic-based as well too. Going through the S&P 500, and look, I'll show a chart after this, which is going to really sort of floor people, but to put what the S&P 500 has gone through in the last 5 months, it's virtually put on in the last 5 months what it took 3+ years to achieve. So in our view, the S&P 500 has gone too quickly, too fast, and you'll see in 2 more slides why we think that, and why we are starting to see what we think we'll see the US markets pull back over the coming weeks. From our point of view, we're always concerned, and we don't really recommend buying an ETF on the Australian market. And the reason being is 38.5% of the Australian index is the banking financial sector. As we can see here, if we look at a log scale, and virtually a log scale is if we look at all sectors that start at the same time, at the same level, at a value of 100, this is how it's performed. So all other sectors are about 140%. If we look at resources, they're about 118%. And financials are actually underwater going back to start of 2014. The banks right now, as you can imagine, they're carrying the can for the property sector, and also too, at the moment, they're not exactly killing it when it comes to their profitability. So if you look here, profitability has been on the steady decline from about 1995 when it comes to percentage return on equity after tax on shareholders' equity. So we're not seeing the banks as the mainstay going forward. And that may, obviously, once again, going back to our conversation before about the averages, obviously if banks are pulling back, then there is a chance that the Australian index may pull back on the back of that, but don't rule out the fact that other sectors won't necessarily pull back in the same way. Obviously, health, utility, IT, consumer staple, those sort of areas we believe will continue to have some longevity and some stability going forward. And the last chart I want to put up is what we call the S&P 495. So here is a chart on the performance of the S&P 500 from 2015 through to 2020. And that line at the top there is the S&P 500. That line at the bottom is the S&P 495. So if we take out Amazon, Apple, Facebook, Google, and Microsoft, the S&P 500 over the last 5 years has only managed to scramble out a 25% rate of return. So just be careful when you are looking at these scenarios. You need to strip away the numbers and look at the underlying data. Certainly, if you held any of those 5 companies, you've done incredibly well. But if you held any of the 495 other companies, then you pretty much averaged an annualized rate of return of 10% every year. All right, guys, well, time to throw open to questions. I'm just going to take a glass of water here to wet the whistle. And thank you for those who have started to enter your questions on the side here. So I'll start running through, and then for those who do have further questions, please go through and start to put those in. So, question here from Michael. G'day, Brett. Thank you for giving up your time. What is your general feeling advice for those of us holding shares in the Big Four banks with respect to the likelihood of reduced or zero dividends over the coming years? Just hold on or potentially crystallize losses or put that money to use elsewhere? Look, Mike, to me, the biggest issue with banks right now is their longevity going forward. If you read the tea leaves and read the verbiage coming out of all the bank CEOs that have been released in the last 30 days, they're not exactly painting a rosy picture. As I put up in that chart before, if you look at the bank sector as comparison to other sectors, and they haven't exactly killed it when it comes to rates of return. They've been a bit of a whipping boy over the last couple of years. They've obviously been dragged through the coals with the Banking Royal Commission. And then the other scenario you've got as well too is how are they going to afford getting their money back from people who can't afford to pay their mortgages? So look, to me, you got to have those sort of I guess come to Jesus moments with the banks, and they're going to have to start to provide a lot more clarity to investors over the coming months as those mortgage deferred or those mortgage holidays start to decrease. Question from Tracy: what happens to the people that could not sell before 30th of July? Tracy, are you referring to the main residence exemption? Is that the one you're referring to? If you just put on there, oh, here we go. So you then said you sold your house before July 30. Where would you suggest we put our money? Let me just, so I'm just scrolling through here to see if you're replying there. So I'm hoping you referred to 30 June, not 30 July, because the main residence exemption did change on the 30th of June. So if you could just let me know in the comments there that that was 30th of June, otherwise you might have more problems than you consider. I'm just going to go back and, yeah, 30 June, sorry, fantastic. Okay, I can breathe a sigh of relief. look, we have received a lot of questions with respect to people who have sold their former principal place of residence because the main residence exemption changes and what to do with those funds. To us, it really depends on your investment timeframe or horizon and your intentions to return to Australia. If those intentions to return to Australia are in the short term, let's say 12 months, then, or even say 18 months, then generally we don't recommend you invest those funds. The investment timeframe is too short, and you're better off keeping that money in cash at the miserly rate of return. If your investment timeframe is greater than 18 months, out to say 3 years, then you may consider taking a very conservative approach to investing. So we're not saying invest a whole lot in equities, but what we classify as a moderate defensive investor may go 20, 30% into equities, 20 or 30% into fixed interest, and the remainder in cash. That way, you're not betting the house on the rates of return, but certainly from that point of view, you are going to get a better return than obviously the term deposits. Actually, Tracy, you just jumped back on there saying 5 to 7 years. Okay, so look, it really comes down to your appetite to risk, combined with where you're located, combined with a lot of scenarios. So Tracy, whereabouts are you located? If you could just let me know. Okay, Dubai. So good. I was hoping you said Dubai and not United States, because the United States is a whole other question. So obviously in Dubai, you're classified, I'm assuming, as a non-resident for tax purposes. When you're investing in Australian markets, you have what's called taxable Australian property, house, apartment, mining lease, or a farm, and then non-taxable Australian property, shares, managed funds, ETFs, LICs. Obviously, taxable Australian property, you do accrue a capital gains tax liability at the rate of 32.5 cents on the first dollar on any appreciation of assets, as well as 32.5% on any positive cash flow that you may earn from those assets. With respect to non-taxable Australian property, you do not accrue a capital gains liability with the ATO, and obviously, as you're based in Dubai, there is no capital gains tax here, so that's not a consideration you need to take into account. Obviously, if you do take a conservative or even a moderate approach to investing in non-taxable Australian property, then over a period of 5 to 7 years, which is what you've outlined, then you could consider obviously investing in a portfolio which may comprise of Australian equities, international equities, Australian fixed interest, international fixed interest, and some alternative assets. If you put in $1 and that dollar goes to $2 in that 5 to 7 years, and you then return to Australia, you're not liable to pay any capital gains tax because they're non-taxable Australian assets. And as you were a non-tax resident at the time of that accrual of that capital, therefore you're not entitled to pay capital gains tax. So we're seeing a lot of people going down that path now. And then when they land back in Australia, hopefully in that 5 to 7 year period, the Australian property market has settled down. They tick that resident returning card, they sell their portfolio, they crystallize the gains, and don't forget, those gains were accumulated while they're a non-tax resident, and then they use that cash then to buy back into the Australian market. So in that 5 to 7 year period, they've appreciated in gains over that period, and then they use that cash to reinvest back in the market. And what you're doing is you're virtually maximizing on both sides your tax status as a non-resident, but also to the fact that what we're seeing out of this, more so the equity market at the moment, and it will happen down the track with stimulus packages for the property market, but just not yet. Obviously the amount of cash that's being pumped out by both the Australian and the foreign governments is unprecedented. We haven't seen these sort of debt levels. Australian debt's going to go up to about 800 billion, and that's on the federal level over the coming years. And all they're doing is they're turning the taps on. The US has done what we call quantitative easing infinity, which they haven't even said how much money they're going to flood into the equity and capital markets. So what we have seen in the past, and this is pretty much what occurred, and what people are likening to post World War II, when they needed to reinvent and reinvigorate the economy post a world war, is we saw all this capital flood in. Now, obviously in World War II, there was a lot of capital rebuilding of cities, infrastructure and so forth. A lot of people have likened it to what's happening right now from a digital innovation point of view and all these scenarios, and the fact that the governments have to get out and start spending to create jobs. So we may see a lot of infrastructure projects coming out. Fun fact for those out there who don't realise it, the Hoover Dam wasn't built because they needed a dam. The government actually needed to create jobs, and that's one of the classic examples of what a government can do to create jobs, is start to spend money on infrastructure. How that looks over the next 12 to 24 months, we'll have to wait and see. But obviously from a equity market point of view, there is a wave of cash coming that way. And as we have seen going through the reporting season just recently, it hasn't panned out to be as bad as we had feared. Okay. So I hope that answers your question there, Tracy. A question from Abdul. From your perspective, and as you mentioned, fiscal cliff, would it be better to wait until early next year to invest in property? Look, from our point of view, Abdul, I would say early next year, maybe too early. The longer that these rental moratoriums exist, the more propped up that market's going to be. It depends on how conciliatory those banks are going to be in terms of how long they are willing to carry their clients in terms of that period. But we may be kicking the can in the road for another 6 months. We're just not sure yet. But to us, if you take, not our opinion, but look at the banks and the body language that the banks are portraying, you've got CEOs saying people may need to sell property. You've got CEOs forecasting from a risk return point of view, a possibility of a 32% fall in property over the next 3 years. Take that as gospel, because they're the ones who are sitting at that coalface and dealing with the customers on a daily basis, and who are going to start experiencing those pain points. So, to me, until we start to see the body language coming out of the banks change, I don't think property is going to be a very appealing investment opportunity for the next 12 months anyway, at least. Question from Paul: if you are forced to repatriate to Australia due to termination, is your overseas provident fund taxed on the earnings in the last tax year or since inception, which may be many years of gains? Please confirm that it is best for money to arrive in Australia in one financial year and you in the next. Paul, you've got it spot on. So essentially, if you crystallize the provident fund in one tax year, then you don't want to return to Australia until the following tax year. If your residency changes in the same tax year as when that gain is crystallized, that is taxed the whole way back to when it starts. So it is a pretty drastic scenario that a lot of people are facing at the moment. And unfortunately, for some it's outside of their control. For those who are able to scrimp and save and stay in their country of domicile and where they reside, if they can repatriate the money in a different tax year, then that is the best scenario. Section 99B is going to be an absolute killer for a lot of airline crew who are in mandatory provident funds and different provident funds around the world. Okay, Tracy covered that off there. Miriam, any advice for property owned outright in Australia? Get out now or hang on, or for how long? Look, it really depends on where your property is. We've seen scenarios like Byron Bay is going gangbusters right now because people are getting out of the major capitals. We are seeing Mornington Peninsula going gangbusters right now. Now, whether that's going to play out and that's going to hold them up, or whether we're going to see people, be able to maintain that lifestyle, we're not sure. It really depends on where it is. From your point of view, you're saying it's owned outright. First comment that I would like to make is I hope that you're making use of your concessional contributions to offset any positive cash flow. But when it comes to do you get out now or do you hang on, it really comes down to both the financial reasons and also the personal reasons. Is it your forever home? Are you emotionally attached to that home? Is it just a transaction and you're happy to chop and change at the drop of a hat? So unfortunately, I don't really have any unequivocal answer for you there, Miriam, because it does depend on a lot of things. For a lot of people, I think they're just weathering the storm. For some who are concerned about negative equity, we are seeing people sell. And for others who are concerned about the market in general, we are seeing them sell as well too. To me, it depends on what price you can get, what the market is doing in your local region. So there are, unfortunately, a lot of different permeating factors there. Question from Alison. Great presentation. Is there any way to get money from provident funds back into Australia in a different form, e.g. buy gold with that money while still overseas? Just trying to work out when you say in a different form. Usually what's the biggest consideration when it comes to repatriating money is obviously you can use that money to buy whatever you want. That's why the ATO do not classify provident funds as a foreign super. as a, whether you're talking about buying gold and then sort of carrying it back to Australia or leaving it overseas, I'm not sure. But I think the greatest risk for expats right now is the fact that what we call the Common Reporting Standard. And the Common Reporting Standard is a global initiative. I think I keep saying 146, it's probably more now, territories and countries that are part of a signatory to share data. If you are in a country, and most people are, that is a common signatory to the Common Reporting Standard, then the ATO already knows about your bank accounts. They already have seen that information. I'm in Dubai. If I have a local bank account here, then our bank here, because they know I'm an Australian resident, as part of their KYC rules, will inform the central bank of the UAE, and they'll pass my bank statements on to the ATO. So the ATO knows more about you than you probably realise, and that's the same case for Hong Kong, Singapore, I'll cover United States in a second. So when it comes to repatriating your mandatory provident fund, you do run the risk, if there is no disclosure and you do try to wing it, that may come back to bite you, because as part of that data sharing agreement, look, the ATO's got their hands full right now, but as part of the anti-avoidance rule 4A, they can go back 4 years after the fact and come back at you for an audit. If they find out in 3 years' time that you got a payout of a provident fund into a Hong Kong or a Dubai bank account, and you return to Australia in that same year, then there may, and also you repatriated the funds in the same year, then there may be considerations there as well too. So in terms of, can you dodge the bullet? Look, honestly, no, as far as we're concerned. Can you get away with it in the short term? Maybe, but in the long term, it may come back to bite you in the backside. Okay, question from Kathy. My friend has a property in Perth. Should she sell or continue to rent? Look, Perth's been an interesting one. I'll sort of, Perth to me is a bit of almost a kid thumbing their nose at their parents when they get away with doing something naughty. Obviously, Sydney and Melbourne markets have been the envy of most property markets, and what we're seeing right now is a bit of a resurgence in the Perth economy, primarily driven by the mining boom. And whether we see it to the same levels as we saw pre the GFC, when obviously we saw houses in Port Hedland and Karratha and those sort of places going for north of $1 million. I don't know whether we see that sort of resurgence in the property market, but we are going to see probably a resilience in the property market by virtue of the fact that if you're in the mining sector and you own property in Perth, then your job is pretty safe. There is an intrinsic relationship between unemployment and property. If you are in a suburb that has a high unemployment rate, surprise, surprise, property market more likely will go down. So, look, do I think Perth's going to be okay? I think so, but it depends on, once again, the actual specific suburb in Perth you're talking about, or Western Australia for that matter. So, to me, it comes back to that. It doesn't take a genius to work out what's going on in the area based on the economic activity. If you're in a region that is prone to travel and tourism, then guess what? You're going to probably feel the pinch. If you're in a region that has, a lot of people in the resource or mining game, you're probably going to be okay. It really depends on the, I guess, the nuances of that area. Question from Janine: do you think higher priced property, say over 2 to 3 million, will drop as much percentage-wise as property under 1 million? Look, I think it's going to be almost the same. If you look at trophy properties, I think they're almost not immune to the scenario right now, but if you're very wealthy, you'll be able to navigate this space, and trophy properties will still trade at the level. However, when we look at property values, say 2 to 3 million, that's, I wouldn't say a normal property these days, but for a lot of Sydney and Melbourneers, they're an average property. That's not considered a trophy property anymore. So depends on the makeup of those properties. If you own $2 to $3 million properties, and most of those people who own those properties own small to medium businesses, and those businesses are going through a lot of problems, then yeah, more than likely they'll be sold off no different to a property sub 1 million. It's going to really come down to what the market looks like in Q4, that's October through to December, and obviously Q1, January through to March. To me, when we see an absence of so many different participants in a property market, an absence and there's a bit of a vacuum in buyers, that's going to expose property to a lot of weak points. So as we said, first home buyers, not that they'd be in that $2 to $3 million range, but certainly investors and migrants, they would be definitely in that range. And those two market participants are completely absent and more than likely will be absent for the next 2 to 3 years. So, it's going to come down to owner-occupiers, and if banks are encouraging their borrowers to downsize, then yeah, more than likely, we will see selling pressure in that 2 to 3 million range. Okay, question from Miriam. I'm still paying tax in Australia. Does that mean if I sell, I'm exempt from the new ruling? Look, yeah, it depends on if you are classified as a resident for tax purposes. Just the fact that you're paying tax in Australia doesn't mean you're a resident for tax purposes, because you could be a non-resident for tax purposes. Look, I would say you need to reach out to us to really cover off on that, because you can be a non-resident for tax purposes and paying tax in Australia. So if you are a resident for tax purposes, then that is a different story. I've actually just put up on the screen there, if while I'm talking this sort of stuff, if anyone does want to reach out to us, jump on our website, atlaswealth.com. If you go to the contact us page, you can go through and just submit an inquiry. The Dubai office and the Australian office, we do 30-minute consults free of charge. So the reason we do it free of charge is A, we want to make sure that we can provide value, and B, you're aware of what our services and fees and respective charges are. So, when we get into these sort of nitty-gritty things, we really can't go into personal advice, because there's a lot of different rabbit holes we need to jump down to work out what's pertinent for you. So, Miriam, just on that one there, if you want to jump on our website, www.atlaswealth.com, jump on and schedule a complimentary 30-minute consult. We do our consults via Zoom, so we're agnostic to region, so we can pretty much cover you from the 2 offices into any country, and we'll certainly be able to sort of go through and cover through some of those key issues. Question from Silo, Great Prezzo. If you are an investor and doing a subdivision in Brisbane, given where we are in the property market, would you go ahead with this project or hold? What would you base your decision on? Look, Silo, I mean, once again, I can't provide personal advice. In generally speaking, as I said, Australian property is considered taxable Australian property. So what that means is, while you are considered a non-resident for tax purposes, if you do increase that property in value while you're away, you are going to pay 32.5 cents in that first dollar to the ATO. You are, as a non-resident, you're no longer eligible for the 50% capital gains discount that was abolished on the 8th of May 2012. So the question is timing. Do you think now's the right time as a non-resident, and also with the property market? Once again, more than happy to answer that question in person, but we can't provide specific advice whether you should or shouldn't go ahead with that. Okay, question from Giles. Very informative presentation. Thank you for the mention earlier about foreign pensions and how this is taxed for provident funds. But does this also include end of service payment from a UA employer? As you stated, foreign pensions in your slide. I understand that end of service is sent back to Australia prior to returning to Australia as a resident, then this is not taxed here. End of service is different. So that's that 13-month we do talk about from time to time. It's different from the point of view of from an earnings point of view, as opposed to a foreign trust point of view. Obviously, end of service is not invested. It's actually part of you. You're just getting a percentage of your salary. So that's why it's different to say a provident fund. A provident fund is money put away and invested. And that's where we talk at those gains that those provident funds do experience. That's what's taxable at the end of the day. Okay, going through the next question from Brock. As a month ago, I moved to 100% cash. What do you foresee the best investment options over the next 6 to 12 months? Look, Brock, it really depends on what your investment time frame is. If your time frame is 12 months, 18 months, like I said, cash. There is so much uncertainty right now. If your time frame is greater than 18 months out to 3 years, then you might look at scenarios of introducing fixed interest as well as equities. If your time frame is longer than that, then you may increase equities. It really depends on A, your investment time frame, B, your risk profile, and C, your time overseas. So it comes back to a lot of moving parts there, but hopefully that gives you a bit of an idea as to what most people are going down that path. Okay, question from Rob. Have institutional investors returned to the market, or is it still retail investors? Rob, it's still retail. We're looking at some data the other day, and what I will do is I'll actually send this out when we do the email follow-up out to to folks, there was, by the time I finished the presentation, this data came out and I didn't get time to put it in, but it pretty much went through and talked about the participation rate of US investors. And right now, with mums and dads from small towns to big cities in the US, they've invested approximately $3 trillion in this period. And it is a cause of great concern. Obviously, the popularity of things like Robinhood and those sort of investing platforms has made it very easy. But whether we see the right participants coming in, obviously we haven't seen Mr. Buffett, Mr. Icahn, those sort of guys being very active. We saw, Warren bought a part of a gold mine the other day, but I don't think that was based on the price of gold. He pretty much got that for quite a good deal. So I think he's just being opportunistic there. But he's still sitting on well over 100 billion US dollars in cash. We haven't seen him deploy that yet. And to me, the big question is I guess the longevity. The longer this goes through, there's going to be companies that are able to weather the storm, and they're companies that we don't think will see further deteriorating balance sheets because they've survived it so far and they've been able to pivot and solidify both their profit and loss and also to their P&L. Sorry, their assets and liabilities. There are companies that are going to rely on coming out of this, and that's obviously travel and tourism, leisure. The longer this drags on, the more damage that is done to them. And we've seen what's happened with Qantas. Qantas sacked their head of international travel the other day, and that gives you an idea of what Qantas's actions are going to be in the next, 1 to 2 years. If they don't need a head of international, they're not going international. And I saw quite a funny comment the other day that, pre the COVID-19, Alan Joyce was very proud of his Operation Dreamtime, I think it was called, where he was going to fly from Sydney to London. Now his most profitable route's going from Sydney to Ballina. So, the goalposts do change very quickly. And I think for the time being, Qantas's focus will be solely domestic until we see any changes. And, certainly when you look at, those sort of scenarios playing out, if we see those periods drag on, people who've taken the contrarian view by buying Qantas, Webjet, Flight Centre, or in the US, buying the US airlines, or the US hotel operators, may be in for a bit of a surprise because the longer this drags out, the more of an economic cost that may be. Question from Gigi. Our family was preparing to sell our parents' home in Australia. No restricted timeline right this minute. Should we try to sell ASAP, or we don't sell soon, so you think we should lose a lot in value? Look, it depends on your time frame, Gigi. If your view on this property is long term, and I'm talking 5 to 10 years, then more than likely the property will recover its value in that period. If you are a forced seller over the next 1 to 2 years, then certainly reviewing the market, reviewing what's going on, and reviewing what's going to happen over the coming years may dictate what your actions may be. It really depends on your view of this property and your time frame with holding this property. That will dictate whether you buy or whether you sell or whether you hold. A question from Giles. Okay, I think I've just covered that one. Question from Brendan. Is there a difference in the CGT rate depending on if you are a tax resident or not? 100%, Brendan. If you're classified as an Australian tax resident, then obviously the Australian marginal tax rate comes into it, and also to 50% capital gains tax dispensation comes into as well too. So those are key considerations. We do have clients that have significant property portfolios who choose to elect themselves to be an Australian tax resident. They're happy to pay the extra tax on the income of their income, which depends on which jurisdiction you're located in, because quite often it can open you to benefits as well too on that side. So yeah, whether you're a resident or non-resident can certainly change your view on the tax rates. Okay, question from Abdul. Another question: would adding funds in superannuation be better off, or investing in equity shares in the Big Four? Look, it depends on your investment timeframe, Abdul. When it comes to whether you put money into super or put it into investment account. Obviously, super is a bit like the mafia, once in, never out. Super is, excluding SMSF, super is taxed agnostically whether you're a resident or non-resident. So there are benefits to contributing to super. There are benefits of managing super in a more active manner. For example, using franking credits to offset the 15% income tax inside super is a possibility. Getting refunds from the ATO on unused franking credits is a possibility. It really depends on you as an investor. We've got clients who make active contributions to super and they're 25, and we've got clients who are 55 who aren't touching super. It really depends on what your view is in how comfortable you are putting super money away in a long-term capacity. And once again, everyone's different. So certainly, if you want to jump on a call, just jump on atlaswealth.com and send us an inquiry. I'm more than happy to answer some of those questions for you. Okay, running through to money. Does UAE gratuity fall in the same category as the provident funds? No, it doesn't. As I said, money before, end of service benefits are an income item, whereas a provident fund is a capital item. That's why, we obviously talk about with, say, the EK provident funds, they are classified as a foreign trust, whereas obviously with your income as an end of service benefit, that's an income item, and that's no different to you earning your normal monthly wage. Question from Matt, have you heard that Middle East governments will be introducing capital gains tax VAT from next year? Look, we've obviously seen Saudi increase VAT up to 15%. They can probably get away with it because 30% of their population are expats, as opposed to Dubai, whereas about 90% of the Dubai population or UAE population are expats. So if they did increase VAT to 15%, I think that'll be not a nail in the coffin for the UAE, as opposed to capital gains tax. Once again, I don't think they would introduce that. I think we'll see other ways that the UAE government can, introduce new taxes, like they do with the alcohol tax and those sort of things. I think we're more likely to see that as opposed to capital gains tax. Dubai and the UAE relies on the property sector a lot with respect to, being a viable investment alternative from a property point of view when you're comparing it around the world. So I don't think the UAE is going to want to introduce capital gains tax just yet anyway, if they're trying to stimulate the UAE property market. Certainly, I wouldn't be surprised if we may see corporate taxes, corporate tax rates start to come through. At the end of the day, for SMEs, the licensing fees and those sort of things are virtually a corporate tax in itself. And as they're a flat rate, whether you're a one-man band or a 100-person company, it is almost quite punitive when it comes to small to medium enterprises. So I wouldn't be surprised if we start to see a corporate tax rate come in, along the lines of Singapore and Hong Kong at around, sort of 10 to 15% level. It may start in at 5 or 10 or 7%. I'm not sure what it's going to look like, but I think that will be probably a pragmatic, consideration. I'm not saying tomorrow or next week or next month, but it may be consideration going forward in the coming years. Okay, question from Rob. At what point in time do you think we'll get an insight into zombie companies once the keeper schemes are wound back? Yeah, 100%. There's a lot of companies out there who have people doing nothing. They're sitting at home and they're on the payroll, but they're not doing anything. And look, it's going to be when the JobKeeper is wound back or the qualification for JobKeeper increases. So if companies are asked to, put in more, put these people to work, then that may be a key consideration. Or if they obviously wind back the dollar amounts, it really depends on a lot of different ways. But yeah, certainly zombie companies, that saying about when the tire goes out, you see who's wearing pants is a great example. Question from Darshi. I have a Melbourne property, no mortgage, but also no tenant. Should I sell now? Look, Darshi, once again, I can't provide personal advice, and the Australian office and the Dubai office are more than happy to jump on a 30-minute call if you want to send through an inquiry at atlaswealth.com. It really comes down to how you consider your return on capital. Is it an effective use of capital? I can't really go too much, I'm afraid, because it would be deemed as personal advice. Question from Giles. As per previous question, what's your suggestion on how does one make best use of concessional funds on fully paid up Australian property? ETFs are about to drop off a cliff. Thanks, Giles. When you say concessional funds on fully paid up Australian property, you're obviously talking about property that's fully paid off, so there's zero debt. Obviously, if you are earning an income on that, you do have a consideration with respect to positive cash flow and obviously the Australian non-resident marginal tax rate of 32.5%. There are considerations there. You can certainly make concessional contributions to super. Look, ETFs are about to drop off a cliff. I would agree to that to a certain degree. If you look into S&P 500, like I said before, there's 5 companies that have virtually driven that to where it is right now. It doesn't necessarily mean you have to invest in an ETF. You can invest in specific companies. Believe it or not, even through the worst of that period in March, there were companies that were going up. ETFs are a very easy way to invest, but it is a one-in, all-in scenario. If you buy an ASX ETF, that does include Qantas, it does include Flight Centre, it does include those sort of companies that are being hit the most. Crown Resorts is another example. But if you go through, you can actually buy companies that have actually been doing quite well. I mean, if you think back to all the memes on social media about buying toilet paper, Coles and Woolies, they're not exactly doing it tough at the moment. So there's a lot of companies out there. It's very easy to throw the baby out with the bathwater, but to me, not all sectors are performing the same. So while I'll say ETFs are a dangerous way to play the market at the moment, it depends on what the composition of that ETF is. Okay, running through question from Ella. Should we be filing tax returns in Australia, even as a non-resident, so that the 2-year limitation look-back period applies as opposed to 4-year period? Thank you. Look, good question. There's a lot of debate as to whether once you leave Australia and you do that final notification, do you need to do 0 returns? For every accountant that I can find that says you should, I can find the equal number that say you shouldn't. To me, it depends on how you sleep at night. If you that sort of person likes to dot the I's and cross the T's, then certainly, doing a lodgement yourself or getting an accountant to do a 0 lodgement, is good business practice. At least the ATO knows what your situation is, not bringing into it. We have heard of a number of people who have experienced financial difficulties who have gone into MyGov to early access, early super, and have been alerted to the fact that they owe the ATO 5 returns. Now, that may be because when they did their last return, they didn't notify the ATO that that's going to be their final return. There's a lot of personal experiences that are different across different scenarios. And, I think we're sort of running just by case study at the moment, just sort of taking a stock of people and what they're experiencing, what our clients are experiencing on an ongoing basis. Certainly good business practice says you want to make sure all your I's are dotted and T's are crossed, and that would mean you would do a 0 return every year with the ATO. But in saying that, we've had people who had no adverse scenarios because they haven't. So that's not to say that you should go down that route as well, but it really depends on how compliant you want to be. Obviously, we always recommend people be 100% compliant, but everyone has their own different scenarios. Miriam, we'll be in touch. Thanks for the great preso. Fantastic. Question from Martin: are consults available to Hong Kong residents too? Look, Martin, James and the Australian office obviously specialise in the APAC region. Definitely Hong Kong. We've got quite a large number of clients in Hong Kong. Jump onto atlaswealth.com, send through your details, and James and the team will be in touch there. And as I said, we are running our consults on Zoom at the moment. In normal times, we do actually travel. We haven't traveled for a while, but yet it's probably the least amount of travel I've done in my working life. But certainly James and the team will definitely be able to help you there. Question from Khalid. Thank you, Brett. Appreciate your time and efforts. When is your next webinar? Look, we've got one happening tomorrow as well. That'll be at 7 p.m. Australian time, which is 1 p.m. Dubai time, 5 p.m. Singapore time. So if you want to jump onto that one, you can certainly do that. James will be talking through probably the same thing I'll be talking about. We're also sending out this. We don't like to do too many webinars. As you know, our last one we did was in April, and we only really like to bring webinars out because we understand people's time is precious when there's stuff to report on. From May, June, July, there was a lot of conjecture, speculation, those sort of things. At the moment, from our point of view, we're doing this now because now we're starting to see hard data come through, and we like to take that hard data and make an informed decision off that, rather than that sort of chicken little scenario of running around with the heads cut off. Okay, Kathy, thank you once again for a very insightful webinar. My pleasure, Kathy. Tracy, what is your thoughts on buying property here in Dubai currently? Look, like everything, I can find good and bad scenarios. You know, obviously Dubai property has come off a lot in the last, virtually since 2014, which is the peak. 30 to 40%, sometimes 50%, or depending on your property, type of property, region. Property, like everything, makes sense for some and not for others. To me, it would possibly make sense for someone who has a long-term view of staying here in Dubai. Obviously rent money, that whole debate about rent money versus dead money, that is a debate for a lot of people, and a lot of people do sort of struggle with paying rent. So, but then again, if your tenure in Dubai is precarious because of your job situation, then buying property may not be the best thing for you, even though it has come down a long way. So look, more than happy to have that chat, Tracy, on offline. But yeah, there are a lot of moving parts to that. Question from Khalid. Generally, is it a good idea to contribute to your super while being an expat as opposed to using extra funds to invest in equities property directly? Look, once again, Khalid, it really is that's a personal decision. Obviously, in super, you're taxed at a rate of 15% on income, 10% on capital gains held for assets longer than 12 months. In investments in your own name, you're not taxed on a capital gains point of view. There is what we call non-resident withholding tax, which is dictated based on whether the country you're resident in has a DTA with Australia or not. So, for example, for those on the call, your non-resident withholdings tax rate is 15%. For those in Dubai, where there is no DTA, it's at 30%. However, you can use franking credits to offset that. But once again, there's a lot of moving parts to why you would do one then the other. It may be based on your age, risk tolerance. So certainly happy to discuss that, offline in a 30-minute consult. So, feel free to sort of send through an inquiry on atlaswealth.com. Question from Martin. Excellent presentation. Thanks. Definitely setting up a consult. Fantastic, Martin. Looking forward to talking to you. Question from Michael. Thank you for answering my first question. My wife and I have been non-residents of Australia now for 2 to 3 years. My wife left our country of residency, Saudi Arabia, in March and has been in Australia ever since, which is 160 days. Saudi has not yet opened its borders to allow dependents to come back. If my spouse exceeds 183 days in Australia, does she automatically become a tax resident again? And more importantly, could this affect my residency? Look, Mike, I think the key consideration is, A, is your wife earning an income? B, if that's not the case, then, I think you've got a pretty good argument to say that you're in Saudi, you're earning income, you're in Saudi. You've also got a pretty good, explanation as to why your wife hasn't returned. Even though I saw in the press the other day that they may open up land borders. Look, it's still not an easy process for you, and there's a very good chance that she may exceed 183 days. To me, just document everything. So if you ever do get that question as to, why your wife is in Australia for greater than 183, you can go straight back with a dossier of information showing that she was unable to return. The ATO has been very sympathetic to expats who are in that situation. They are always saying that if your expectation is to return to your country of residence as soon as practically available, then they will not classify you as a resident for tax purposes. Obviously, with Saudi, it's not practically available, and that's your reason why she hasn't returned. Question from Alison, just a quick one. Where do you see the US dollar going compared to the Aussie dollar in the next few months? Look, this is a good one. Believe it or not, since March, obviously, March we saw a rush to US dollars. There was a shortage of US dollars, and that's what's caused the Australian dollar to fall as much as it did. Since then, the US Feds have turned on the taps and just flooded the market with US dollars. So to give you an idea, in the market, there's 18% more US dollars than there was in supply than there was back in March. So at the moment, the Australian dollar is where it is, not because it's strong, but the US dollar is weak. If we see probably 2 or 3 different scenarios pan out, if we see, for example, a shortage of US dollars occur, and that may be driven by a risk-off scenario where the market does get concerned and it does fly back to US dollars, then we will see the Australian dollar fall. Will we see it fall back down to the 56 range? Look, I doubt it. And the reason being is we saw a gross shortage of US dollars, and that contraction of the Australian dollars, was caused by that. Now that we have a lot more US dollars in the market, we may not see the same panic. Look, it depends on, obviously, probably 100 different scenarios. The first scenario is what's going on with US-China relations. Second is supply of US dollars. Third is economic scenarios coming out of the US. Are they able to reignite the economy? There's a lot of scenarios there panning out. And to be honest with you, I can't see a catalyst why the Australian dollar would change much more in the next 2 to 3 months. We'd have to see a pretty big economic event for a change in those beliefs as to why the dollar is at 71 or 72 or 70. I think the Australian dollar is going to be range bound for the better part of the next 2 to 4 months, and it could be anywhere between 72 and 69 and everywhere in between. Question from Dave and Joe. What's your prediction for the Australian dollars over the next 6 to 12 months? Look, that could be pretty much predicated on what happens with A, the Australian economy, and B, the US economy. And the longer this pans out, the more damage it gets done. Will we see an erosion in investor appetite for any particular currency and or country? Generally speaking, if we didn't see all those extra US dollars out there, I would expect the Australian dollar to be in the sort of low 60s, mid 60s at the highest. Because we have this extra 18% out there, that's why we are seeing, the Australian dollar in that, low 70s. It really comes down to how the countries, if Victoria can get a hold of, obviously, the outbreak, we can see numbers go down and the lockdowns decrease, then there's no reason why the Australian dollar would be any more than where it is right now. They've got the economic situation under control, like we saw those flash PNI numbers for the later part before Victoria went in. Things are actually on the improve in Australia. It's the erosion of sentiment and the unknown longevity of these scenarios that, to me, is going to be the biggest scenario going through. So if I had to put a number out there, and look, when you're forecasting currency at a 6 to 12 month view, my daughter, 9 years old, God love her, would probably have more of an eye than I would, because it is almost a bet. And actually not, it is a bet. I would say range bound 65 to 72 is my 6 to 12 month number, but that could change tomorrow. It is like sort of tapping your head, rubbing your stomach, and jumping on one foot while chewing gum at the same time. It really is almost impossible to say. A question from Gigi. If selling a house in Melbourne within a year, then do you think selling ASAP is the safest bet? Look, G, once again, I can't provide specific personal advice. The Australian office and the Dubai office, we're happy to, take that call offline once we learn more about you and can discuss personal scenarios. I think I've painted a picture of what I think the property market's going to do. I think the CBA and the NAB have sort of indicated what they think the property market's going to do. So, read some tea leaves and have a look there. Question from Stephen. We own one property in the US and want to move back to Australia next year. Do we have to sell before 30 June to avoid capital gains tax? Look, Stephen, reach out to James and the team by sending through an inquiry on the website. That's obviously a particular specific, question that only we can handle in a one-to-one conversation. So James is, well adept in terms of navigating the IRS/the ATO landscape there, and would be more than happy to answer that question. Question from Brendan. Would I be better to wait until I'm back in Australia as a tax resident before selling investment property in respect to CGT? Look, depends on when you intend to sell property. As an example, let's run through a hypothetical. You bought a property as an expat, you lived overseas for 5 years. During that period of time, you're not entitled to any special dispensations. If you were to sell that property one day or 1 week or 1 month or 1 year of being back as an Australian tax resident, it doesn't change that tenure of that 5-year period. It only changes what gains or taxable scenarios accrue from the day that you return to that country, obviously Australia, until the time you sell it. So if, for example, you've owned the property for 10 years, 5 as an expat, 5 as a resident, then the exemptions and the dispensation and the allowances only apply while you're a tax resident for that 5-year period, not for when you're away. So it really depends on your scenario, Brendan, in terms of whether you sell before or after. If you have an intention to sell, one day after becoming a tax resident, there's going to not be a lot of changes there. Question for Reese, 2 questions. Which banks will allow you to open an account remotely? We are in Dubai. Second question, suggestions on best way to transfer money back to that bank. Look, the banks chop and change all the time. We have heard of scenarios where Citibank and HSBC possibly allow you to open up an account by remote. That depends on whether you've got a relationship with them already. You have to consider the fact that these banks don't really know you from a bar of soap, so they are concerned that, are you a terrorist and all these different scenarios, and that's why they generally insist on you walking into a bank. In extreme circumstances, we have heard and seen of people using a power of attorney, combined with that power of attorney, walk into a bank and doing a Zoom call and doing it that way. I think that was the exception, more the rule. But to be honest with you, I guess to give you the flat answer, I haven't heard of many banks in this environment we're in, the COVID environment, allowing that. But not to say it can't happen, because I have heard of special scenarios where it has happened, but it hasn't been an easy process. Question from Gigi, thank you for your presentation. My pleasure. Reese, thank you for your time and efforts. Happy to have. Question from Stephen, have you heard of anyone yet who has been blindsided with huge principal residence acidity bill? Not yet, but that's because if they are selling post 1 July, that's this year, and that won't be accessible and reportable until next year. It's going to happen. Unfortunately, there are going to be people who do not or are not aware of that change, the main residence exemption, who may sell their property, not knowing this rule exists, and they've sold it because they've lost their job or they're moving country or what it may be. Unfortunately, we are going to see some pretty bad scenarios coming out in the next financial year, which will be from July through to October when they start reporting those returns there. So not at the moment, Stephen, but not to say it's not going to happen. Unfortunately, there's going to be some pretty sad tales that are going to pan out from that one. Question from Sulo. What is your view on the AUD? I think I've just covered that off there with David and Joe's answer. Question from Money. If you had spare 100K AUD, where would you invest it as an expat Aussie? Look, I'm probably reluctant to answer that question because it really depends on your risk appetite, your investment time frame, all those sort of scenarios. So, to me, when we look at assets to invest in, we look at the upside potential versus the downside risk. At the moment, property, is at its peak. It is, very expensive, and there are massive tailwinds coming through. The downside risk is certainly greater than the upside potential. Equities, I think it's a fair weighting, downside risk versus upside potential. So obviously from a asset, point of view, equities, certainly looks more appealing at the moment than property. But once again, it does depend on your risk appetite and investment time frame. A question from Sulo. Thank you so much. I'll be in touch over the next couple of days. Great, Sulo. Looking forward to hearing from you. Question from Michael. That's the Saudi one. She's not earning income. So yeah. So to me, your scenario, it may not be as complicated as it sounds, but once again, we don't want to go into too much detail. Personally speaking, we can only obviously reference general scenarios. But if you want to get in touch, Michael, just hit us up on the website atlaswealth.com. Dave and Joe, many thanks, Brett. Great preso. My pleasure, guys. Matthew Platt, great presentation, mate. My pleasure. Rosalind, not sure if this is on topic, but do you know if I can open a Citibank account in the US and in Australia and transfer the funds without a fee? Actually, that reminds me, Rosalind, I didn't answer questions about transferring cash. Obviously, trying to avoid banks, guys, to transfer cash. They'll take between 4 and 6% of the value of the transfer. They may say they won't charge fees, but they'll get you on the bid-ask spread. So where possible, use a currency broker, OFX, World First, TransferWise, Currency Fair, you name it. There's a swag them out there. do everyone, but don't use the banks. So Rosalind, just to answer that question and segue into that as well too. Obviously, how do you transfer funds? So Citibank and HSBC both do this, and they do it incredibly well. They position and prepare your accounts in Australia and Dubai or Hong Kong or United States, where it might be, and enable you to transfer money real time between a Australian account and an overseas account. They may say that they're not charging you a fee, and they're probably not charging you a fee, but what they are getting you on is what we call the bid-ask spread. And an example of that is, let's say, for example, the Australian dollar is 70 cents to the US dollar. That's the market rate. But when you go in there, you're not going to get 70 cents. You may get 67 or 68, or you may get 72 or 73 if you're buying US dollars. And that's where they make their money. As an example, when you compare it to obviously currency brokers, it can range between 1% down to 0.3%. So if you are transferring a small amount, or especially a large amount, we're talking thousands, sometimes tens of thousands of dollars that you can save. So, tip, if you're going to take any tips from tonight, don't use banks to transfer cash. Go through the little bit of extra effort to set up a currency broker account and do it that way. Your wallet will help you. Sorry, your wallet will say thank you. Question for Money, thanks for a great presentation. Great. Rosalind, fantastic. Righto, guys. Well, if there's any other questions, now is the time, as I say, or forever hold your peace. I'm just going to change this here. Okay. So I'll put my ugly mug back on the screen. Right, guys. So is there any other questions there? Trying to work out how to get my camera back on, but this may not be a bad thing, by the way. Okay, question from Alan here. I was just distracted by a phone call for 5 minutes. Okay, I'm not sure what that is about. Question from Adam. Thoughts on metals and crypto? Metals certainly on the back of China. If China's economic demand continues, then metals will continue to be strong. It's pretty easy from that point of view when it comes to who the main customer is and what's occurring, as opposed to where things are going, in the BHP and Rio space. As long as their customers are happy, then everything else will continue. Crypto, look, we understand and know blockchain very well. We don't get involved in crypto, mainly because from a licensing point of view, it's not deemed as what's called a financial product by any of the regulators. It is unregulated, so we're actually not allowed to provide financial advice on crypto. As to the importance of blockchain, look, blockchain's massive. It's here to stay. At the end of the day, a lot of people are using blockchain. All the Australian banks, the top 4 banks, use blockchain right now. So it is here to stay, as opposed to investing in crypto. Unfortunately, guys, we can't provide any advice on that one, I'm afraid. Which currency broker would you recommend? Look, to us, we'll always back Aussies. So our first port of call is always OFX, which is an ASX listed. Used to be called Oz Forex, used to be called US Forex. They've brought it all together now to OFX. The reason we always look at an Australian company, or B, anyone else, is we want protection and licensing. At the end of the day, if something happens with an Australian licensed currency broker, you have recourse at the Australian Financial Complaints Authority. If they lose your money, you have someone to go to, and you know how to navigate that space. If you use a foreign currency broker, you have to learn about how to lodge a complaint and how to get your money back. So that's always a big consideration for who to use in a ongoing capacity. Question from Alan. Do you have a recommendation for who provides the lowest fees for transfers? Look, our experience is for the larger amounts, it's OFX. They'll beat everyone. For the small amounts, generally currency fair and transfer wise, but when it comes to larger amounts, we've seen OFX always going to bat and beat everyone else. Okay, question from Brennan. What were the names of those currency brokers to transfer money from UK to Australia rather than using a bank? Look, Brennan, as I said, OFX, if you've got to support an Aussie company, might as well be them. World First, another one too. And on the smaller amounts, currency fair and transfer wise, do them as well too. But obviously, we'll use whoever you want. Question from Gigi, by the way, you were visible the whole time. Both screens were available. Okay, okay, that's good. I guess I apologise. I'm not exactly the most handsome of guys. Okay, so, question from Adam, are expats able to access any first homeowner grant assistance or the 5% government-backed deposit to purchase property? No, because essentially to qualify for those things, it has to be a principal place of residence. It has to be where you get to live, and if by virtue of you living overseas as an expat, it wouldn't be your principal place of residence, so expats aren't able to access any of those grants. Paul, question of US 401ks, is it worth maxing out 401k contributions for the tax break if only planning to stay in the US for less than 5 years? Look, Paul, great question. Send it through to James. Send it through an inquiry at atlaswealth.com. Obviously, we can't go into specifics in terms of personal recommendations, but yeah, James lives and breathes the 401k space on a daily basis, so he'll definitely be able to help you with that question. Question from Sergio, if you work for UN and have been away from Australia for more than 5 years, are you still considered a resident or non-resident? Look, Sergio, interesting one. Obviously, we've got a lot of clients who work for the UN, and whether you qualify as a resident or non-resident will come down to those 4 tests: the resides test, the domicile test, the 183, and the Commonwealth Super. So the fact that you work for the UN won't dictate whether you are a resident or non-resident. It'll be dictated based on those 4 tests. But certainly, if you're away for more than 5 years, then certainly the resides, the domicile, and the 183-day test may point you in the right direction there. Can you define small amounts, please, from Kat? Okay, when transferring cash with the currency broker, I'm talking, sort of 1 to 5,000 as a small amount, even 500, I guess. But when it starts to get up to the 5s and 10s, especially 20s to 50s, and then well and truly above that, that's when we're talking about the larger amounts there. Question from Paula. I've had consistently good, fast, and efficient experience from OFX. Yeah, look, we like them. To us, it's the reason we work personally with OFX is we can pick up the phone and find someone accountable, as opposed to talking to a call center who doesn't know who you are from a bar of soap. So we always say you pay peanuts, you get monkey when it comes to service. Question from Alan. I have another 401k question. How do I contact James? What is his last name? Yeah, James Ridley is the managing director for the APAC region. He runs the Australian office. If you jump on our website, atlaswealth.com, and let me just put this back up on the screen here. It's probably better if I put this up here. Okay, just go through to the end. Sorry guys, I'll just. Okay, so just if you just send through an inquiry to atlaswealth.com, Alan, then that'll go straight to James and the team, and he'll certainly be able to help you there. Kat, not a problem at all. Okay, guys. Any other questions? If so we are proud of that 30-minute complimentary consult. So if you guys do have any questions that we haven't been able to cover off here, or the 10,000 other questions that we always get from expats, trust me, we've heard them all, then jump on there, atlaswealth.com. Also, too, if you just want to follow us to pick up information from an osmosis, or just sort of keep in touch, we are very social. We're on Facebook, Instagram, Twitter, and Facebook, LinkedIn, Twitter, and Instagram. we're not exactly that great on Instagram, so I will preface that there's a lot better pages to follow if you're visually orientated, but we do try and be of a service there. But certainly Facebook and LinkedIn are two areas that we do provide very regular updates, and Twitter to a certain degree. So guys, if there's any other questions, here you go from Adam. Do you recommend expats to buy cash flow neutral properties, or is negative geared okay with deferred tax benefits? Look, I mean, I think there's a bit of a misnomer, Adam, with respect to the whole let's buy a negatively geared Australian property and accrue tax credits. To me, you're still losing money and you're still putting your hand in your pocket to fund that. Yes, you accrue tax credits when you get back to Australia, and yes, you can offset that against your Australian income, but you're just getting your money back. You're not actually getting a rate of return. So it comes down to the asset. It comes down to, is the property itself making money, as opposed to is it creating tax credits? I think there's a whole industry out there that's designed to sell the belief and the dream of building up tax credits back in Australia, but really you're just getting your money back as opposed to making money. So I think it's more than whether you buy something neutrally or negative gears to get the tax benefits. I think it's more about is the asset making you money? If it's not making you money, it's pointless building up tax credits. If you buy something for 500,000 and goes to 400,000, but you've got all these other tax credits, you've still lost $100,000. So hope that answers your question there. Any other questions, guys? We're just gone through the 2 minutes and an hour and a half mark there. So actually, not longer than that, 2 hour mark. So. Right, guys, I think that is about it. So we might wrap it up there. I'm going to go have a drink, water, of course, no beer, but losing my voice here slowly. So any questions you guys have, once again, please feel free to send through an inquiry at atlaswealth.com, and also follow us on the social media pages. We'll certainly keep everyone focused and up to date on any events that occurred going forward. And I'll bid you all a great morning, afternoon, and evening. Have a fantastic time, guys. Take care and be safe. Thank you.